May 27th, 1992. A boardroom in Toronto. 31 floors up, Paul Reichmann sits at the head of a table surrounded by lawyers. Outside, the markets are already moving. The phone stopped ringing an hour ago. When the phones stop, it means everyone already knows. By the end of the day, the largest private real estate company on earth will be insolvent. The question is not how they lost everything. The question is how three brothers from a refugee family in Morocco built an empire that owned more sky than any private entity in history, and why one city, one project, one gamble undid all of it. Samuel and Renee Reichmann did not set out to build an empire. They fled Vienna in 1938, escaping the violence of Kristallnacht by a margin of days, crossing borders with their children until they reached Tangier, a city of exiles on the edge of war. In Tangier, Samuel traded currencies and built a reputation for discretion and fair dealing, while Renee organized food parcels for refugees and pressured Spanish officials to issue life-saving visas. The Reichmann household ran on discipline, ritual, and silence about private affairs. The Sabbath was sacred. Business stopped, no matter the stakes. Charity was not a gesture, but a duty. After the war, the family left Morocco for Canada, unsettled by political uncertainty. Edward, the eldest son, arrived in Montreal in 1955 and started Olympia Flooring and Tile, importing European ceramics. Paul, Albert, and Ralph soon followed, settling in Toronto. They worked as a unit, brothers not rivals, expanding the tile business before moving into construction and then property development. Their word was their bond. Contracts were honored without negotiation. They closed building sites every Friday before sundown, even if it meant losing money. Privacy was absolute. The Reichmanns shunned publicity, refused interviews, and gave little hint of the scale of their ambitions. Their early years in Toronto were marked by relentless work, frugality, and an operating code shaped by exile and faith. A code that would define Olympia and York as it grew from a family business into a force capable of reshaping city skylines. In 1977, Olympia and York stunned the real estate world with a single transaction. They purchased 8 skyscrapers in Lower Manhattan for $320 million. New York was still reeling from its fiscal crisis. Buildings stood half empty, and established players saw only risk. Paul Reichmann saw something different. Within 4 years, the value of that portfolio soared past $1 billion as Olympia and York refinanced, leased, and repositioned the towers while others hesitated. The company's reputation for speed, discipline, and reliability spread. Lenders who had once doubted the brothers now sought them out. The scale of their ambition became visible in steel and concrete. In Toronto, First Canadian Place rose 72 stories above the financial district, completed in 1975 as the tallest building in the Commonwealth. In Manhattan, the World Financial Center transformed Battery Park City with 4 glass towers and 6 million square feet of office space, delivered on time and fully leased by the mid-1980s. At their peak, Olympia and York managed a global portfolio approaching 8 million square feet, employing more than 10,000 people, with assets valued near $20 billion. Paul Reichmann's instinct for distressed value had become a doctrine, attracting bankers and city officials eager for the next transformation. These were not speculative leaps, but calculated conquests, each one reinforcing the sense that Olympia and York could turn risk into certainty. By the time the London Docklands beckoned, the Reichmanns had built not just a fortune, but a legend of infallibility. On October 27, 1986, the London financial markets changed overnight. The Big Bang deregulation swept away centuries of custom in a single day, unleashing a surge of capital and competition that outgrew the medieval grid of the city. For Paul Reichmann, the opportunity was unmistakable. Where others saw derelict docks and empty warehouses on the Isle of Dogs, he saw a blank slate for a new financial capital. Olympia and York secured 71 acres, land so cheap and so vast that only a private empire could contemplate its transformation. The plan called for 12 million square feet of office space, a scale that dwarfed even their New York conquests. The site would demand 25,000 workers at its peak, pouring concrete, driving piles, and raising steel frames at a speed that recalled the company's greatest triumphs. London's planners promised a business district to rival Manhattan, with tax breaks and a fast-track approval process. The master agreement, signed in July 1987, committed Olympia and York to the largest commercial development in Europe. The vision was not incremental, it was total. Paul Reichmann spoke of Canary Wharf as a necessity for a city that had outgrown its heart. The logic was as uncompromising as the ambition. If London's future belonged to finance, then the Reichmanns would build the city that finance required. In the shadow of the Big Bang, the empire that had mastered risk prepared to bet everything on a single, audacious answer to the question of what the future demanded. 3 warning signs, each ignored or underestimated, converged on Canary Wharf before the first tenants ever arrived. The first was isolation. Despite years of negotiation, there was no commitment to fund the Jubilee Line extension. The only rail access was the Docklands Light Railway, a system designed for local traffic, not the daily surge of bankers and brokers the project demanded. Without a direct underground link to the city, the towers of Canary Wharf stood marooned, their promise of connectivity unfulfilled. The second warning came from the market itself. Olympia and York had always filled their buildings, but here, pre-leasing lagged far behind projections. By 1990, as the first phases neared completion, only a handful of major tenants had signed on. Morgan Stanley, Credit Suisse First Boston, and a few others took space, but the anchor leases needed to secure long-term financing never materialized. The City of London, threatened by the Docklands experiment, countered with new office towers of its own. The market responded with indifference. Vacancy rates in London's financial core soared above 20%, and Canary Wharf's glass facades reflected back empty floors. Then came the macro shock. Interest rates in Britain hit 15% in 1990, just as Olympia and York's borrowing peaked. The cost of capital soared, the recession deepened. Every percentage point meant millions more in annual debt service, money that had to be paid whether or not tenants arrived. The fit-out financing that once bridged the gap between construction and occupancy evaporated. The arithmetic that had always favored the Reichmanns now turned against them. The empire's greatest wager was suddenly exposed, not by a single mistake, but by a convergence of external forces that no private resolve could overcome. The arithmetic of ambition turned hostile. Olympia and York's wager on Canary Wharf was underwritten by a $12 billion loan, an edifice of leverage strung across 91 banks in 4 countries, each one bound to the project with syndicate agreements and cross-default clauses. At its peak, total debts exceeded $20 billion, a sum that dwarfed even the largest private real estate gambles of the era. The creditor map stretched from Toronto to New York and from London to Tokyo, a web of obligations that left no room for retreat. As interest rates soared and tenants hesitated, the syndicate's patience thinned. Deadlines for interest payments arrived with mechanical regularity, each one a test of solvency that grew harder to pass. The banks, once eager to finance the Reichmanns' vision, now moved as a block, insisting on new terms, demanding collateral, and threatening legal action. The family's private empire, built on trust and discretion, found itself exposed to the cold logic of collective risk management. With every missed payment, the vice tightened. The numbers no longer bent to willpower or reputation. They ruled absolutely. The legal machinery of creditor protection, once unthinkable, became the only shield left as the syndicate closed in. On May 14, 1992, Olympia and York sought protection from its creditors. The filing was not a pause but a reckoning. An empire built on discretion and certainty was now laid bare before the courts. One Canada Square, the tallest tower in Britain, stood 60% vacant. Its marble lobbies echoed with the absence of tenants, a monument to ambition outpacing reality. Subcontractors and suppliers, many of whom had staked their fortunes on the Reichmanns' word, went unpaid. Pension funds and small banks across Canada and Britain absorbed losses that would ripple for years. The construction workforce, once 25,000 strong, vanished almost overnight. In the boardroom, the logic of numbers replaced the logic of trust. Paul Reichmann, who had steered every deal and every risk, was forced aside by creditors and advisors. The company he had shaped in silence was now controlled by a committee of outsiders. The cost of vision, measured in billions, left the family with nothing but the memory of what they had built and the burden of those they could not protect. Today, Canary Wharf towers above London's skyline, its value now measured in billions, its origins in a single, overreaching gamble. In a market still ruled by debt, timing, and vision, the line between prescience and hubris remains razor-thin. Empires endure until the sky moves beneath their feet.